This year has been the worst outflow episode in the history of emerging markets debt. And as a result, valuations look historically cheap. So is now the right time to jump into EM? We look at EM investment through three lenses: valuations, technicals, and fundamentals. On the valuation side, they look undeniably attractive. EM has suffered disproportionately through tightening of financial conditions and hiking of interest rates globally. So from a valuation side, when we compare it and contrast it to US corporate credit, we think emerging markets looks attractive indeed. But from a technical perspective, we have to look to see when the worst of the financial conditions tightening is behind us. At that point, we think EM may be poised to rally. But it's also at that point where the fundamentals can become more important. We want to try and bifurcate between the winners and the losers within the asset class at that point in time, because those country-specific risks can manifest very quickly and very unexpectedly. So in summary, we prefer to be cautious and wait for more clarity before pivoting towards a more outright bullish stance. We expect the growth in emerging market assets to continue as the number of countries and companies issuing debt is set to increase. Local markets in particular are where we've seen the strongest growth, which we see as a positive sign, as they generally offer higher diversification benefits and can also immunize the issuer from the stresses that come from a stronger dollar and higher US rates environment. Two areas that we're watching carefully are the development of corporate issuance in local currency and less liquid private credit issuance. Local corporates do not formally have a benchmark as of yet, and consequently are not widely allocated to. But the area is growing fast. Less liquid EM credit offers investors the ability to harvest higher yields and liquidity premiums that are still quite rare, at least relative to the US and the European Union, where private credit industries have matured over the past decade. The main takeaways for investors are that EM should form a structural part of your asset allocation decision. It's too big an opportunity set to ignore and to think of from a tactical perspective. And in fact, it's one of those rare opportunities that offers both yield and diversification benefits. We think investors should tread carefully in the asset class, especially in those higher yielding names, but not to avoid that part of the asset class completely. There will be invariably winners and losers in this asset class, and I think that underscores the need for active risk management and analysis.